Hello, and welcome to Zero Cash Flow Assets, the 38th episode in the Crossing Thin Ice podcast series, brought to you by Actuarial Risk Management. This is Dave Ingram, and I'm joined today, as always, by Max Rudolph. Today, Max will be seeking to answer the question, is there a role for zero cash flow assets? This is an asset class that has been growing rapidly in the insurance company portfolios recently. These assets are often private securities that are purported to have a higher yield than publicly traded bonds with semi-annual coupons, which have been the mainstay of insurer portfolios forever. Max is going to look at this asset class to see how it might fit with two very different types of insurance liabilities, and also to see how it might have a role in a surplus portfolio. But before we go on, I want to mention that nothing we say here is intended to be investment advice. We intend to provide educational material only for risk managers. So let's get started.
Whether a product of today's added complexity or a result of the recent reach for yield when rates are low, more assets are being held by insurance companies with irregular or deferred cash flows. Some find this a natural progression, while others never find it appropriate. The answer is somewhere in the middle. It depends, but often can add value when done in moderation. Here we will walk through examples that differentiate specific products between times of stability and stress. Let's consider products and methods. First, with two different products. One is issued by a life insurer, a single premium deferred annuity, or SPDA. One premium is received and earns interest based on the assets backing it in a segmented portfolio. The other is an auto insurance policy issued by a property and casualty insurer, where a premium at the beginning of a period provides coverage for that period and is repriced each period. And a third situation will be assets that do not back a specific liability and are assigned to surplus. For each of these three examples, two scenarios will be presented. One will be a calm, stable period where financial outcomes are strong. The second will be a stress scenario with high correlations between and within asset classes as market values drop. Most asset cash flows are split between principal and income payments. As a simple example, you buy a bond, pays interest periodically, and the principal is repaid at maturity. There are a wide variety of options after that, with banks and shadow banks generating nearly any desired payment stream. Some assets, like non-dividend paying equities, have no cash flows in perpetuity, and bonds can build up principal rather than paying coupons. Now let's visit our product scenario combinations. First, the SPDA. An SPDA is sensitive to interest rates. There is a guaranteed credited rate, so when rates fall, the policy is more likely to persist. If rates are stable or close to it, the block has a steady withdrawal rate. But if rates rise quickly, the policyholder can do better elsewhere, so the insurer endures what resembles a run on the bank. Some insurers have invested in novel, illiquid asset classes like sports teams, venture capital, or private equity. These have a wide range of structures and may rely on capital gains to provide future cash flows. Assets have traditionally been purchased to create cash flows with some conservatism that meet the time horizon of the liabilities. Some may need to be reinvested if income and principal arrive prior to the cash flow needs of the liabilities. When markets are stable, an SPDA is profitable, cash flows are manageable, and the assets are relatively liquid. While using all non-cash paying assets would make the block more fragile, the risk during these periods would be low. But markets don't remain stable forever. If rates change materially in either direction, what had been a reasonable asset liability management or ALM duration or cash flow match demonstrates its convexity risk and the mismatch grows. For the SPDA, if rates rise, more cash is needed to pay withdrawals and the assets are less valuable, even if they are liquid. For an insurer with a concentrated block in an SPDA product, this can lead to insolvency, especially if there was already an ALM mismatch. So if rates fall, an insurer bleeds slowly, and if rates rise quickly, the insurer either becomes insolvent or survives and moves forward. An auto insurance policy has premiums collected up front that offset claims and expenses. This is referred to as float and can be invested in longer duration and less liquid assets, since most policies are retained due to auto insurance being legally required. A competitive marketplace provides few advantages for the car's owner to constantly shop a policy. Having a non-cash generating asset in the portfolio is reasonable during both stable and stress times. Liquidity, however, remains essential if cash claims rise due to parts or labor inflation or social inflation, since there is a lag before premiums can catch up. Assets in a surplus portfolio have less need for cash flows or conservatism, but still must be available during times of stress, such as following a natural disaster, market implosion, or pandemic. The insurer's own building, along with illiquid assets and asset classes inconsistent with product investment strategy, is often found in the surplus portfolio. There are few restrictions, but it should be remembered that a form of leverage called enterprise or surplus duration includes these assets, so can be used to double down or offset effective duration mismatches created elsewhere. It can be a good home for the insurer to add yield, including some non-cash paying assets. Risk management is all about balancing risk and return, and part of that is managing risks so strong correlations in stressful times don't overwhelm an asset portfolio. Interactions between interest rate risk, liquidity risk, and credit risk should be balanced so a bad scenario doesn't push an insurer into insolvency. Stress testing can identify where these overlaps occur. Other risks of concern deal with concentration and thinly traded markets. In a liquid market, you can sell an asset easily and at the market price without taking a haircut. But liquidity is typically needed most when risks have increased. Buyers are few and correlations high. Short-term liquidity, especially when everyone knows you have a problem independent of the market, can be costly. Credit risk tends to have high correlations during market stress, and earned rates are higher for more risky fixed income instruments. Spread can also be earned by accepting risk tied to other variables, but these generally increase yields by less than 10 basis points. There's not a single one-size-fits-all investment strategy for an insurance company. Each is unique based on products sold and risk appetite. Some have expressed concern when assets with no recurring cash flows are included in an investment strategy. As we saw with SPDA, this can be a problem, but as always, the situation is more nuanced than that, and these types of assets can serve positive roles in a diversified portfolio. Insurers typically have expertise in some areas, but not in others. They may be very good at managing short-term liabilities and prefer a conservative portfolio, or they may view home and auto liabilities as float, like a loan, and focus on their investment expertise. Others understand complex financial instruments or reinsurance transactions. A balance between all these interacting risks using narrative scenarios can, with some redundancy and conservatism, result in reduced risk overall. Before we move on to part 2 of today's podcast, we want to tell you about ARM's ERM Advisory Services. Our ERM advisory team, led by Dave Ingram and myself, Max Rudolph, are available to provide a wide range of support to your enterprise risk management program. Here are samples of recent projects.
Risk appetite and tolerance statements are the key linkages between ERM and company strategy. We worked with an insurer to provide a very practical approach to setting up and updating their risk appetite and tolerance statement using examples from other insurers. We also provide an approach to linking risk appetite and tolerance to individual risk limits. Max, can you provide an example of an asset that would be hard to model and that's illiquid?
Yeah, one that I think most people are familiar with, and I'll provide a little bit of the details here though. But since 2012, when Guggenheim Baseball Management bought the LA Dodgers, right before their TV contract was renegotiated for a large increase, ever since then, a number of insurance companies have held part of that baseball team in their portfolios. The team value has more than doubled since then in estimates. But I've always wondered how I would model it for projections. It's not obvious to me. And then last year, Japanese superstar Shohei Ohtani signed a record contract that then deferred most of the $700 million sum that he's going to receive for the first 10 years. So the team is an illiquid asset, and the deferral impacts other contracts, both now and later. I mean, they're able to sign other people now, and they probably will have trouble signing some people 10 years out because of that contract and when the cash flow comes into play. And then in addition to that, both my hometown Detroit Tigers and my adopted Kansas City Royals have a TV broadcast contract that the broadcaster has is in financial limbo, whether it's going to go insolvent or not. And that could impact MLB TV contracts for all teams. So the lucrative contract that the Dodgers have now could be rescinded. This would be a great case study for modeling an alternative asset class. There's others, but that's one that I've thought about for a long time, and I really don't have a good answer to it. So if anybody knows how this is being done, feel free to drop me a line or write it up as a case study yourself.
Well, with regard to these zero cash flow assets, what do you think? Do you see any similarities between what we're seeing now with that and anything that happened in the past that concerns you?
I'm reading a book right now called Investing in U.S. Financial History, and the author, Mark Higgins, made a comparison from the late 1920s that I wasn't familiar with until just recently, and I've been able to confirm it through other sources. But at that time, shadow banks, led by leading industrial firms like Bethlehem Steel, Standard Oil of New York, who's now Exxon, and GM, were making what they called call loans. So loans that were callable on demand, with many used as margin loans against stock purchases. So these loans were going out. And then when you got to October of 1929, all of a sudden the loans got called, and it really played into the quick fall of the stock market in a feedback loop. And so, in addition to the poor underwriting during that boom period, keeping so much of the credit market out of reach of the Federal Reserve meant it's harder for the Fed to take away the punch bowl. That's their job, is to try to slow things down. So their tools became less useful because there were so many of the credit risk that was out of reach to them. And so with the global economy less resilient right now due to the high levels of debt that we've incurred, this could be an area to watch going forward and one that I'm watching.
Interesting. I hadn't heard that story before. Max, what advice would you give to a chief risk officer whose company is considering diversifying their portfolio with zero cash flow assets for the first time?
My advice here is pretty much the same as for any new asset class. I think you want to start slow. You want to manage initially from a low concentration, especially if the initial debt cycle hasn't been completed for the new asset class, meaning you're getting lots of good returns, but haven't had an excess of insolvencies from the credit risk. Maybe invest in the surplus portfolio first before using an alternative asset to back product, or a zero cash flow asset to back product. It's important to understand any regulatory requirements. I mean, the NAIC in particular has been putting some requirements on some of these asset classes just recently. And if you're just coming into it and you're looking, even 5 years back, the rules have changed, and you want to make sure you have expertise in-house, and you understand what those requirements are and what they mean for you. And I also think it's important to work with the modelers to develop, our favorite stress test, determining ahead of time what's going to cause both positive and negative outcomes to play out. So I think all those are important. Dave, how do you foresee the role of zero cash flow assets evolving in the insurance industry, maybe over the next decade or so?
Yeah, I guess I think of it going the way uh, other asset classes have gone that are new. Is that, I think as we get experience, we'll be able to do a better job with the modeling for the ALM process. Maybe nobody has a really good way of modeling those assets right now, but I think the word will get around when somebody comes up with something. Everybody will adopt a robust way of modeling those. I would think that there's going to be something, either a definition that puts some of these assets on the Schedule BA, or a different schedule that's like Schedule BA that will be classifying these assets into the riskier versions of these versus those that are well supported. I think higher capital requirements are going to accrue to the riskier set of these assets on a systematic basis, not just an ad hoc basis. I think, as you suggest, Max, we'll go through a cycle and we will get some default experience with it. Just like junk bonds, when they came in, everybody was very optimistic valuing them at first during the first big boom of the junk bond issuance market. And nowadays, I think we have a pretty realistic set of default assumptions we apply to junk bonds. With appropriate capital requirements and appropriate default assumptions, then we'll see that the excess returns on this asset class aren't quite as generous as maybe we might be thinking now. There's still going to be something there as an excess return because of the illiquidity premium that folks should expect. So I think we'll be dealing with just the right issue there, the illiquidity issue, rather than the mixture of all the unknowns that we have now. We also will recognize, too, that when we look at this, everything that a portfolio manager picks on of these asset classes isn't going to be above average. A lot of the picks will be average, and some will be below average, and some will be above average. And I don't think we have to damn the whole class because some are bad, and I don't think we have to put the whole class on a pedestal because some are good. And recognize that there's a mid-range there that's going to be where most things are.
Yeah, that's a good point. We've seen several of the regulators come out and specifically talk about some of these asset classes, and I'm much more comfortable saying let's look at the practice as opposed to who's doing things, because it really doesn't matter who's doing it. It's a matter of how do we manage it and how do we make sure that the industry stays stable over time.
Thanks, Max. That review of the potential benefits and problems that might result from these zero cash flow assets not only provided insights into those investments, but you also gave us a template for looking at future investment opportunities when they come into the picture. And we hope you join us next time. We start to talk about scenario planning in 10 steps, which is an extension of our discussion of regime change scenarios. On that note, we end today's podcast. We hope that you have learned something from this episode of Crossing Thin Ice. If so, please like, subscribe, and share the link with your coworkers.